morning. Thanks for joining us today for our Tax 101 seminar. I'm joined today by Philip May, who is a director in our Calgary office, and we are going to be talking about estate planning for U.S. citizens in Canada. This is a pretty hot topic that's come up, so I think there's always more to say on this topic. What you'll see on your slide is we will be taking questions through at the end of this presentation. There is a section at the bottom of the Zoom screen where you'll see Q&A. If you have any questions, please make sure just to type it in there. And then we have Francis and Kathy, who are behind the scenes moderating the questions as they come in, and they'll be able to provide them to us at the end of the webinar so we can answer some of them live. Also, when the survey is over, you will receive a link to, when the webinar is over, you will receive a link to a survey. We ask you to please take the time to fill that out. It's fairly short, letting us know any other topics that you'd like discussed, or if you have any feedback for us on our webinar series as they've been going so far. So what are we talking about today? U.S. estate tax. So first off, we'll just have a very quick refresher on what is U.S. estate tax, how is it taxed, and who is subjected to U.S. estate tax. Although in this webinar, we are kind of focusing on U.S. citizens mainly that are exposed to U.S. estate tax and resident in Canada. Also, we'll be talking about what is the difference between the Canadian tax system and the U.S. tax system at death, because they do have some nuances in the way that they tax your estate upon passing away. So it's important to make sure to understand the differences, because whenever you're looking at possible plans to put in place, you need to make sure you know what those nuances are so that you're not creating a situation of potential double tax exposure. Then we'll talk about what some of the common Canadian strategies that are in place and any inherent issues that you might see that start to creep in if you start to use the Canadian strategies merely just looking at the Canadian tax law and not taking into account the US side of things and the different types of exposure for tax that could be triggered if you choose to implement some of these strategies. Now, they will work, some of them, if planned through properly, but you need to make sure that they are aware that there's certain nuances of it when you're dealing with different strategies available. And then we'll talk a little bit about who the executors be of an estate, as well as the implications of having U.S. beneficiaries of a Canadian estate. And those ones we'll touch on just a bit briefly, just to kind of highlight some of the concerns that you should keep in mind when creating your wills and what wording you should have. We're not going to talk about the wording because that's mainly done at the legal level, but just some of the things to be aware of when writing those. So to kick it off, talking about what is U.S. estate tax and who is subjected to that tax. So the U.S. estate tax is for U.S. citizens on worldwide assets. So as we've talked about in previous webinars, non-residents of the United States are only subjected to U.S. estate tax on U.S. situs assets, meaning real property in the United States, U.S. stocks, etc. However, U.S. citizens, they're exposed to U.S. estate tax on their complete worldwide estate. And that includes all real property, all personal property, tangible property, intangible property. You actually have to take into account the full fair market value of your estate when you pass away to determine what is subjected to tax. Now, there's a lot of times when we run into situations where we get asked, well, how do we know what the fair market value is? For certain things such as stocks, it's fairly easy because it's on the stock exchange. We can pick out the fair market value of public stocks. But when you're dealing with things such as, real property or shares of private corporation, partnership interest units, to determine the fair market value of those, you actually sometimes need to do a bit of work and maybe engage a third-party valuator to assist in creating a document that helps substantiate what the value is of those shares. A lot of times people say, well, I think it's this, or I think it's worth nothing, or whatever the case may be. And you run a risk that if you choose to not go into the full detail about figuring out what the true value is, especially if you're a person that's kind of teetering close to that exemption limit that we'll talk about on a further slide, you could run the risk that you choose not to file a U.S. estate tax return because you're below the threshold. But had you had a fair market value calculation done by a valuator, you potentially could have been over that threshold. So really, when you're dealing with a lot of estate tax and anything for that matter that we talk about in all the strategies, you want to make sure that you're using the right value on a go-forward basis. So I think now, there are nuances between the Canadian and the U.S. tax system, where we talked about the U.S. tax as the fair market value. And Philip, do you want to maybe go into a bit of the details about what the difference is between the two systems?
Yeah, sure. Thank you, Krista. And kind of a little bit extension talking about the fair market value of the estate as of the day of death. Also, the U.S. estate tax return requires substantive documentation supporting the values, right? So even though the value is probably properly stated, you would want to make sure that the proper documentation has been prepared. So in the case of the IRS is auditing certain estate tax return, you have the proper supporting. With that, so I'm going to just discuss the difference between Canadian and US estate tax at death. For most of our audience here, they're probably more familiar with the Canadian tax implication. When a taxpayer passes away, that the deceased taxpayer are deemed to dispose most of the asset at the fair market value on the day of death. So any accrual gain before death would be taxable on the final tax return of the deceased taxpayer. There were certain exceptions. There was certain planning idea, including using some of the capital loss realized by the estate on some of the carryback. There was just some of the tax planning idea that is available for the use. And for Canadian tax, the pension would be includable at the full amount on the deceased final tax return. So the full amount would be taxable on the final return. There was some strategy about deferring the Canadian tax at death, including there was some transfer to the surviving spouse, depending on the property, or some of the pension could be transferred to the surviving spouse and defer the tax to the surviving when the surviving spouse pass away eventually. In contrast, the U.S. tax imposed estate tax on a totally different way. They don't quite care about how much of the gain was accrued on those property. Instead, they would rather looking at the fair market value of your worldwide estate. So they have different provision on what kind of asset would be includable in the gross estate, and then then you have to establish the correct fair market value on the day of death. Then they calculate the estate tax using that value, subject to certain exemptions. There was also different way of deferring the U.S. estate tax at death. We listed some of the common one is the transfer to a surviving spouse. So if certain asset was owned jointly, either by joint tenancy with right of survivorship, with the surviving spouse being the joint tenant, then some of the asset could be just directly passed to the surviving spouse without being includable on the deceased taxpayer's estate. So by you basically deferring the U.S. estate tax by doing the transfer directly to the surviving spouse. So with that said, for the U.S. estate tax, there was one major concept about the lifetime exemptions. You could think about it as essentially the exemption to a certain amount of estate that is not going to be subject to any estate tax. So the exemption amount is subject to inflation adjustment. Currently, as of the year of 2022, we have about $12.06 million of exemption. Any estate that over the exemption amount would be taxed at about 40% tax rates. And each individual taxpayer would have the same amount of exemption. So for between a married couple, you are talking about exemption about $24 million. And then such exemption would be adjusted to about $13 million coming the January of next year. One key idea about the exemption is a hot topic on the mind of the administration office. So the current exemption was double as part of the Tax Cut Job Act back in 2017, effective 2018, that basically doubling the exemption as of that time of $5 million. That law is supposed to be sunset as of 2026. What it means is when it's 2026, the current exemption would be reduced to about half of the exemption the year before it. So it's roughly $6 to $7 million, depending on how bad the inflation would be for the next 3-4 years. And then also the Biden administrative office kind of proposed even further reduce it to only $5 million. So as you could see, during the COVID time, the office has spent significant amount of physical spending. So they need to come up with additional revenue for the country. So estate tax on wealthy family is always a hot topic. So this exemption is likely subject to change in the future.
Yeah, I think, and I mean, a lot of people always say, what's the likelihood of the exemption amount going down? Biden has been trying to get this through for a few years. I think it got dropped off the table so that he could get other laws passed through in order to create the Inflationary Act that just went through. But that 6.2 is actually an automatic rollback. So there's no laws that need to be passed for that to come into play. It's an automatic cutback.
Yeah, just I think Krista mentioned this is automatic because any law that introduced by a part of tax reform is supposed to expire in a fixed number of years. The current exemption is expiring in 8 years from 2018. So coming in 2026, even whoever it was the elected president at that time, if they didn't push any proposed tax law change, we would only get half of the exemption amount as of 2026. So as you can see, that it's quite a significant drop. So there was also some planning opportunity between now and 2026 to potentially using some of the exemption amount. One thing to point out is, even though our topic is focused on U.S. estate tax today, the exemption is shared between estate tax and gift tax in the U.S. It's logical because you could think about it, if U.S. citizen could get away from estate tax by gifting all their assets before they die without any tax implication, then obviously nobody would be subject to estate tax. So that's why any gift that is over the annual exemption amount would be considered as taxable gift. The taxpayer have the option of using the exemption to just shield some of the gift tax applicable on those gifts.
Yeah.
So and then with the exemption in mind, then we are going to introduce some of a newer concept that is only applicable for U.S. estate tax purpose. It's called generation skipping transfer tax. In short, it's also called GST. So for practitioners like us that practicing in both sides of the border, it got confused when GST was brought up. It applied to give to at least 2 generations below. So it applies if you want to make a gift to your grandchildren, your great grandchildren, then it would apply. This tax is applicable in addition to U.S. estate tax. The reason for this specific tax to be applied is for the reason that IRS wants to close the possibility for you to just gifting to the furthest generation possible. Instead, you have to kind of keep it 1 generation below, and then the next generation will be push it down to the next generation. So every generation, whenever they die, they would be subject to the estate tax at 40%. And then they basically, IRS want to take a 40% cut every generation die. If the generation skipping transfer tax was not in place, then for a wealthy family with significant wealth, then they could just push as much money out to the furthest generation out to avoid paying that 40%. So that's why this tax was introduced, and then it's also applicable in addition to U.S. estate tax. So currently the GST tax, the maximum tax rate is the same as the estate tax rate of 40%. There were also exemption that is available. So currently the exemption is the same as the lifetime exemption we mentioned, the $12.06 million. Then you could whoever you're the donor of the gift or the decedent, you could make some allocation of the exemption to shield some of the gift from the GST tax. That allocation have to be made on a timely basis and is irrevocable. So as you can imagine that if, say, there was a estate of $25 million, half go to the children and then half go to the grandchildren, then you would have to allocate the exemption to that 12.5 million that was allocated to the grandchildren because it's gifted to more than one generation below. So that's the kind of the GST tax. Krista, do you have any comment on it?
Well, I mean, like you said, Philip, at the end of the day, a lot of this is, and we'll be talking about gifting next, but a lot of this just goes into the logic of why do they have these laws in place? And as you said, they don't want people skipping over a generation to avoid that 40% hit at every generation that exists. Now, there are certain exemptions available, obviously, that, you know, maybe the parents passed away, so you have no choice but to give to the next generation or things like that. But you need to be aware that you can't merely just kind of go all the way down the ladder to distribute your wealth to avoid that hit at every level. So it is important to keep that in mind, because I quite often grandparents give their grandchildren gifts, right? And you don't necessarily think about the implications if you're a US citizen to give your grandchild a gift. And there are implications. So
yeah, exactly. I think right now we are trying to raise the awareness and then try to making understanding the reasoning behind any tax kind of helps you understand, oh, okay, it actually makes sense why they introduce such tax. This tax is, I guess, easier to understand or reasonable comparing to other tax that they try to introduce. But again, I think the key here is really if any deceased taxpayer, they have significant wealth that over the exemption, the lifetime exemption, that they would have some subject to estate tax, we would want to review if there was any gift going to a generation that is more than one generation below, and then make some of the allocation of exemption on the timely effections. Otherwise, the estate was subject to additional tax that they was not factoring originally.
Exactly.
And also, it's also a key reminder for the executor, assuming the taxpayer that died, they were just not able to make the exemption. It's really up to the executor to make sure that the timely allocation was done on a correct basis.
Exactly.
So with the kind of the brief discussion about the U.S. estate tax, the Canadian death tax, and the GST tax, we are going to move on to some of the common tax strategies, and then also the problems that it comes with.
Yeah, exactly. So the first one that we run across as kind of going on with the gifting, continuing with the transfer tax that we were just talking about, is gifting. And this can work, and it actually is a fairly powerful tool for estate planning, is pre-gifting. And as we talked about earlier, the exemption amount is set to drop in a few years. So it might be able to take advantage of some of that. And we don't know where the estate tax will be in 3 years. Since I've been practicing over 20 years, it's gone from 2 million to 20 million to unlimited to 5 million to 10 million. It's all over the map. So you never really know where it might settle. And when it's high, it sometimes is actually advantage to take advantage of that higher threshold to pre-gift some of that. Now, from a US tax perspective, you can gift up to $16,000 per recipient. And if it's a spouse, it's actually $164,000. That threshold is mainly for reporting purposes. So if your gifts are under that threshold, you don't actually have to report the gift tax return to disclose those gifts. If it's over those thresholds, then you are required, as we talked about in a previous webinar, to file the gift tax return. And as Philip alluded to earlier, it grinds down your annual or your lifetime exemption for estate tax. So you can use it in advance, but it is something that you need to be aware of, that you are grinding down your exemption now. I mean, a prime example of this is, say you have some shares right now that actually have fairly nominal value, but you anticipate in 5 years they're going to be worth a substantial amount. It might be worth gifting them at this point in time when they're worth less value and moving them, and then that value grows in the person's hands of which you gifted it to. Now, you need to be careful when looking between Canadian and tax law, because although from a US tax position, there's no deemed dispositions, you could potentially trigger a deemed disposition in Canada if you gift this to certain related parties, which means that if there's an unrealized gain within that asset that you're gifting, you could have a taxable capital gain reporting on your tax return for the year that you choose to do the gift. So you need to be a little bit careful, because you might create a situation where you have some double tax exposure that starts to creep in, because if you have the deemed disposition in Canada in the year of the gift, but future down the road, it's going to be subjected to disposition. If you're gifting, say, to another US person, they'll have US tax on that with no increase in basis. So you have a little bit of a mismatch there, if you will. The other side of it is under the Canadian attribution rules. Even though, for instance, if it's stock that you're gifting, even though, and there's a lot of nuances to the whole attribution, I'm not going to get into all of the details of that today, but you may be exposed to a situation where let's say you gift some shares to someone. All of that income, and depending on who you gift it to and what type of income, it may be reportable still on your return. So let's say you decide to give your non-US spouse your shares. If there's dividends payable on an annual basis on those shares, that income is still your income and not your spouse's income under the Canadian. You can't split your income that way. It's called an attribution rule. So you really need to be careful when you're looking to gift, that you're taking into account both the Canadian laws and US laws. And there are times we actually plan into attribution, and it's okay, but you want to be very cognizant of what you're doing when you're creating those gifts and doing those gifts in order to make the best of both the US side of the border and the Canadian side of the border, because never in tax planning do you want to be stuck in a situation that you have no ability to claim foreign tax credits, thus creating a double tax exposure that could exist if you don't have foreign tax credits available. So it is again a very powerful tool that exists. However, if it's not done right, you can actually create a lot of risk for extra tax.
So Krista, seems like it's a lot of common theme that whenever we are dealing cross-border tax, you would always have to pay attention to the tax law in both sides of the border.
That's right.
But yeah, some strategy works perfectly fine on one side of the border, but once you introduce the other factor, like say being a U.S. citizen, etc., then it suddenly becomes a problem, right? It's actually key to just think about all the factors before the plan was implemented. So some of the item that I thought about the gifting is Krista talking about using some of the exemptions. So one logical question would be, hey, what about if I say I use $12 million of exemption and then it goes up to 13 next year? So the taxpayer would be allowed to use the additional amount for the tax year that is after the gift has been made. So let's say you make 12 million in 2022, and then 2023 the exemption goes up to 12.96, and you could gift another $960,000 in 2023 and use that exemption. And then so what about in 2026 when it goes back down to maybe $7 million? Are they coming back to chase all those gifts that you make that is over the exemption? They are not going to. They basically calculate the exemption in the year that you make the gift. Once you claim it, you claim it. They are not going to chase back. So that's why it's really important to think about, depending on your comfort level or your forecast on how the exemption would go up and down from now, it might make sense to use the high exemption that is provided before 2026. If you're forecasting the exemption to stay low for a long time and you're getting close to the kind of older age, you want to use some of the gift, it's a good time to do it between now and 2026.
Exactly. That's exactly it. And like you said, they're not going to come back after you when it drops back down. It's once it's gone, it's gone.
Yeah, so I think, Krista, we're moving on to the next one.
Yeah, I think, and then the next thing we talk about is asset ownership. So a lot of times we get asked questions of who should own this asset. Because a US citizen, maybe you don't want to have all the assets in your name because you're going to be subjected to US estate tax, so you put it in your spouse's name. There is a little bit of, again, some strategy where you have US citus assets put in the US citizen spouse's name, and then non-US citus assets in the non-US spouse's name. Now, in essence, this does work to not have the US or non-US spouse subjected to US estate tax, and reduces the overall limit, or the gross estate value of the US citizen, so that potentially they're below that 12.06 or 6.2, whatever it is in the year. Now, again, this goes back to what we talked about on the gifting. You really got to watch out for the gifting rules, because let's say one spouse works and one spouse doesn't work. If the working spouse who makes all of the money puts assets in the non-working spouse's name, that's a gift that exists. And if it's over that 164,000 threshold that we talked about, then or sorry, 100, yeah, 100, no, it's 120,000 or something like that for a spouse. If it's over that threshold, then you're going to have the gift tax reporting. You're also going to have the Canadian attribution rules. So you really need to think about who, not the beneficial owner, because there's no real such thing as a bare trustee or bare trust in the US, but rather whose money created the value. And if it is the US citizen spouse, you are still actually exposed to risk.
Yeah, so it actually could go the other side as well. So in case a non-US spouse is making the money and then suddenly putting all the money into the joint account, and then if the property happened to be a US tangible property,
That's right.
then it could be actually exposed to US gift tax as well, in a more unfavorable position, because the non-US spouse doesn't have access to the lifetime exemption like the US spouse does. So it could be quite punitive. So I think we just urge all the audience that whenever you're thinking about changing the ownership of certain asset, you think about the tax implication as well. There are other reasons of why you want to have a joint account, but you would want to think through everything before you getting into this type of ownership structure. Sometimes there could be some unforeseen tax implication that is related to those change.
Exactly. And I think at the end of the day, when you're a spouse, generally a lot of people put everything in joint name, and that is a common practice, because in Canada it doesn't really matter. And similarly in the US, if you have two US citizens, it doesn't really matter, because you have that joint tenancy and you can own them together. But once you're mixing a non-US and a US, you really need to be cognizant of what you're doing.
Yep. So the next strategy I'm going to talk about is using trust. So trust is a pretty popular and powerful planning vehicles. A lot of Canadian wealthy family, or even not so much, that they were thinking about using a family trust, maybe for income splitting, on avoiding probate, etc., all the various reasons. So whenever you have a US citizen spouse and a non-US citizen spouse, you have to think about, hey, does it create an additional problems in terms of a US income tax, or really the trust is good enough to protect it from US estate tax for the US citizens? So some of the example would be if the non-US spouse have a trust interest in both the income and the capital, a portion of the estate or the trust would likely include it in his or her estate whenever he died as well. So whenever you are thinking about the trust settings, you would kind of have to pay special attention to what kind of goals you want to achieve, whether the vehicle is good enough on both sides of the border. And also, we have previously discussed in a previous webinar about the different income taxation of a foreign trust, a non-US trust. In the case that it could be controlled by a a US person, that it could be a foreign grantor trust, that all the income would be allocated to the US contributor. In case of a non-grantor trust, then you're getting into a pretty punitive tax regime of distributable net income. All those things add to the income tax burden and also the compliance costs. So some common Canadian trust that could be used in terms of estate planning is something we call a spousal trust. Essentially, what it is the settlor of the trust contributed all the assets to the trust, and then contributed the asset to the trust at the day of death. The trust was set up as part of the non-US spouse's will for the benefit of the US surviving spouse. And then during the lifetime of the US surviving spouse, he or she would have all the income from the trust. But the moment he or she dies, the capital of the trust would go to a succession beneficiary, likely a children or a grandchildren, whatever that is. So by doing so, any asset held by the trust would not be includable on the US US spouse's estate. So you essentially keeping that asset away from the US estate tax systems. So whenever we set up that, we would want to be careful about the US trust reporting that we just mentioned. Whenever a US person that is related to a non-US trust, you would want to go through that analysis about the trust residency, whether if it's not a US trust, then whether it would be falling into one of the category is either granted trust, non-granted trust. It would be okay if all the income is distributed annually to the US beneficiary. There's usually just a bunch of reporting requirement. It would not create additional US burden on the US beneficiary, but we would be really careful about how the trust was drafted, make sure that it fits all the requirement to be a spousal trust to begin with.
Yeah, and I mean, the other side of that too, when you're thinking about it, especially if you're setting up a Canadian trust, you need to take into account the 21-year rule that exists and the reporting in Canada, right? So it's as well as the grantor trust rules and the income flowing through, and as you said, it could be the capital goes to the future generations. You still have all of that reporting in Canada, plus the Canadian rules you need to take into account, because there is limited life available for trusts in Canada, unlike the US.
Yeah, you're right. And then the next one, we're going to bring up some of the example of a US trust. This is probably a relatively new concept for a lot of our audience. It's called US Dynasty Trust. In contrast to what the 21-year rule Krista just mentioned for Canadian trust, the US Dynasty Trust is something we call a perpetual trust. That means it could last forever if it was set up properly, and only under certain states. So every state in the US, they have slightly different trust laws. Certain allows them to be perpetual, certain state only allowed up to a couple hundred years. But in contrast to the 21-year rule in Canada, that is kind of uniform, the US kind of gives you a more flexibility. The use of dynasty trust is kind of the main goal of it is just try to avoid the generation skipping transfer tax, because as we previously discussed, that if a wealthy family, whenever the taxpayer died, they pass the estate to the next generation, and then IRS usually take 40% cut of it, and then the next generation die, the asset transfer to the second generation down, and then it takes another 40% cut. So eventually, all the family wealth would be end up going away by the form of estate tax. So dynasty trust was set up this way that whenever the first die, it contributed all the estate into the dynasty trust, and then the dynasty trust would just sprinkle out income to the different generation. So generation 1 would get some income, generation 2 would get some income. But when generation 1 die, he or she would not have any access to the capital held inside of the trust. So by doing so, that capital would not be included as part of his or her estate. and not subject to estate tax. So basically, you put a pot of money into the trust, and then the trust just keep paying out income to each generation. And then also those generations passing away, they are not going to pay the 40% when they die. So it sounds great, but it's the dynasty trust. For a trust to be a dynasty trust, there were a lot of different requirements about how the trustee, how the succession of the trustee, which state you could write it, you could incorporate the trust in, and also one key area that for our audience to pay attention is the potential Canadian tax implications. So assuming that some party related to the dynasty trust have some Canadian connection. Let's assume a Canadian wealthy family that the founder of the family that passing away, and all the future generation has moved to the US. And then he want to use the dynasty trust for the benefit of future generation. We want to make sure that when he contribute the asset to the dynasty trust, the trust would not be deemed to be a Canadian resident trust. In the Income Tax Act, there were there's a provision to make sure that if you have a Canadian contributor to a foreign trust, that trust basically be deemed to be a Canadian trust. This measure was kind of introduced to close the possibility of kind of wealthy families setting up those offshore trusts and avoiding paying Canadian tax. So that's why they are deeming it a Canadian trust and subject to Canadian taxation. And then the beneficiary, if they receive a distribution, they will be subject to withholding, etc. So the common solution to it is make sure that the contribution is coming from an estate. And then once the contribution has been made, the estate basically close right after. So it ceased to exist. So now you no longer have a resident contributor to the trust. So the trust could avoid being subject to Canadian tax. Because once you're subject to Canadian tax, all the drawback or the bad outcome comes. The 21-year rule would be one of them. So even though it's perpetual in the US, on the Canadian side, you have to dispose every 21 years. You lose the purpose of the dynasty trust.
Mm-hmm. Yeah, and I think a lot of times US citizens would have, say, beneficiaries both in Canada and the US, right? So if you potentially can segregate out your estate so that the US beneficiaries have this with the US executor, trustee, in order to make sure that it's going to be hard because you have a Canadian contributor, right? So I would say that there's so many things kind of with all the last things that we just talked about with respect to the trust, putting assets in someone else's name, is all you've got to really look back to the gifting first to see if you have a gift being made, as well as the attribution rules that exist in Canada, as well as the residency of either the trust or the person. Because both countries actually have rules regarding, and it's same as an individual, regarding where is the trust a resident or the estate a resident. And we'll talk about that a little bit further in the next slide. But it is something you really need to be careful of, as you said, Philip, because you can create this amazing plan, but then you have a deemed resident trust anyways in Canada, and it's kind of there's nothing to it anymore because you've lost a lot of the value of the perpetual prospect, right? So
yeah, so I think the key keep going back to emphasizing is whenever you're planning any tax planning, when you're dealing with more than one country, you really have to keep close mind on both countries' taxation, how it works. And there would be some amazing vehicle that you could use, but there are some criteria you have to get in first, and then also the implementation. So let's say this one for the dynasty trust, you know that they have to be wound up on the same day. But what if you just keep it for a year or two? Then you basically tainted the whole planning, right? So everything have to work perfectly to achieve the tax result.
Exactly. Yeah. And I mean, that's kind of why today we're talking about what some of the issues are or problems are with the different strategies. It's not to say that they don't work. It's more to raise the flag to say, if you're planning on doing this, make sure you're contemplating all of these other things so that you don't trigger a double tax for yourself or exposure to a double tax.
Yeah, exactly. And then I think with all the strategy we have talked about, and Krista gonna discuss about the executive of an estate.
Yeah, exactly. And so I alluded to it a little bit earlier in which talking about the executor of an estate. And this is actually personal for me because as an example, my mother had phoned me one day to talk about her will, letting me know that she was going to put my cousin on as her executor. And I said to her, well, Ma, you can't do that. He lives in the US. And she said, well, why not? And I said, well, because it's going to just create a whole bunch of problems. So it's people are moving around the world now. And unfortunately, people write wills and then kind of leave them to the side and don't keep them updated. But it's actually very important to ensure that your executor of your estate is in the same country as your estate. Or the majority of your estate. I do understand people own assets worldwide, but if you're a US citizen living in Canada, you would best be served by making sure that your executor is also in Canada, because that's where your estate's being probated. And it might be that you want executors for different types of things. But what happens is if you potentially put an executor on your estate that is not a resident of Canada, you might have a situation where your estate actually departs Canada and becomes a US estate instead of a Canadian estate, subjected to all of the trust. I'm going to use quotations because it's not trust in the US, the trust reporting rules in the United States, because what they look at is where it's basically similar to an entity. Where's the central control and management of this estate being conducted? And if it's not in Canada, then it's very likely that you would have a departure tax return for that estate. Now, where that becomes an issue most prominently is if you have spouses. So you have one spouse that's, say, down in the US, and this happens more often than some people might think, where you have one spouse in the US and one spouse in Canada. And if the US spouse in Canada passes away and the executor is the US spouse in the US, you can create actually a lot of issues, because you first have a tax-free transfer to a spouse in the US, but Canada is going to tax it because you have a departure tax, because all the assets in the estate is leaving Canada. So it can actually trigger quite a bit of issues for reporting purposes for the estate if you don't have an executor in the same country. And as with everything, it's facts and circumstances based, but you need to make sure that when you're creating your will, you're constantly making sure to update it if people are moving around the world. And right now we're focused on Canada and the US, but they could move anywhere in the world and become a resident there, and you potentially run the risk of that. The other side of it, you were going to say something, Philip?
Yeah, I want to say that kudos to your mom that she was asking for professional tax advice before she actually do the will, right?
Yeah.
That's always the first advice to our client prospect. When you think about doing some tax, or maybe not directly tax-driven decisions, it's good to check whether it's going to create some tax problem.
Yeah.
And then make sure that you tweak it and make sure you understand the implication before you actually do it. Most of the time, if you already implement certain planning, it's already too late to kind of fix it, or it comes with a tax cost to fix it, right?
Well, exactly. And I mean, in her defense, she wasn't even asking me. She was more just telling me that this is what she was doing because she didn't want to burden me or my sister with it, who are in Canada. And her financial advisor had told her to do it. And I was like, no, you can't do that. And so just be aware that that exists. And unfortunately, not everybody kind of goes through the full thinking of the implications of where an executor is, because it does matter. And the other side of this is the executor is actually liable for all taxes. And this is a big one, actually, when we talk to a lot of people who haven't been diligent in their US tax filings as well, where the executor actually continues to hold that liability for the non-reporting of US tax returns. And I've had to deal with estates that the executor didn't feel comfortable continuing to hold that burden. So they tried to do the streamline of voluntary disclosure reporting to the US. And it's a lot harder to find the information for someone else, let alone yourself. So it's just important to remember, as an executor of the estate, you do hold personal liability for that estate. And so if it's an estate that's crossing a border, potential exposure to other tax, you run the risk. And I know we've talked about this lots, and people always ask us, well, how are they going to come after us for the money? I live in Canada, they can't get me. And I mean, it's okay to have that impression of it, but countries actually have agreements for a collection of tax and sharing of information. So it's not quite as easy as I live in a different country, they can't get me. If it's quite a big number, you're going to bet that the authorities will try to collect this some way, somehow, because it is a situation, and I do understand it's ruled by the US courts and all of that, but like I said, the countries, just think about your bank account right now. You have to actually report to your Canadian bank account a W-8 then or W-9 if you hold US investments. That's a US form, but Canadian banks have to collect it, and banks around the world for that instance. So I think it would be naive to believe that they have no recourse to try and collect money if it exists in that situation.
Yeah, Krista, I think it's especially true when you're dealing with the IRS. I mean, the strongest country in the world, the IRS just could flex the muscle and get other country to do the other things, right, that they want, right?
That's right, exactly. So it's just making sure that when you're completing your will, make sure the executor is in the same spot.
Yeah, and also another reminder for our audience: if you accept it to be an executive for another will for your friends, families, you think about, oh, you are actually personally liable for some of the tax. So before you sign on to be the executive, you have to think about, hey, what's the tax consequence or the liability to myself before accepting that role. But because once you accept it, it's almost too late for you to get out. Krista, talk about kind of what would be the implication for having a foreign or non-Canadian executor. There was also similar consideration we have to give to the beneficiary side. So we're going to talk about what happened if you have a US beneficiary of a Canadian estate. So it's almost become common or repetitive now. Anytime you have some party that is outside of the country that you resigning, then you could expect certain complexity comes with it. So one of the common theme that we have seen is the family, maybe the taxpayer die in Canada, maybe the children already moved down to the US, and then they have to be the beneficiary of the estate. Anytime that when the trust is ready to distribute property to the beneficiary for the full payment of his or her interest in the estate, it's kind of treated as if the beneficiary has disposed his or her interest is in the estate. And depending on whether the estate, kind of what assets inside of the estate, let's say if it has significant amount of asset was tied to a Canadian real property, that disposition of trust interest or estate interest could be considered as a disposition of taxable Canadian property. So CRA kind of try to impose kind of withholding tax whenever a non-Canadian person has disposed of taxable Canadian property. Because you think about it, if a US person owning a Canadian real property and want to sell it, if they don't withhold a tax, it's really hard for CRA to chase that US seller on the gain or the proceed of that Canadian real property. The same applies to this concept. Essentially, the estate, if they have more than 50% of the value tied to a Canadian real property, the withholding tax would be applicable. And then the beneficiary, they could try to reduce the withholding tax, saying that they don't have a gain on the interest by obtaining a clearance certificate. But the application process could be time consuming, and then you have to make sure every party involved was on the same page, make sure not the tax is going to be remitted to CRA. On the other hand, it's also could be a cash flow problem. So if you think about it, if they only have, say, a family home, but not a lot of liquid asset, it's really tough to come up with the withholding tax that is 20% of the value of the real property. You would actually have to borrow money, or you have to come up with idea of how to pay such tax. So that's kind of the implication for distributing a property or capital to a U.S. beneficiary. There was also this implication when the estate is distributing income to a U.S. beneficiary, because right now the income got allocated to the beneficiary is subject to tax on the beneficiary's hand. CRA want to make sure that the beneficiary will pay its fair share of tax. And since the beneficiary is not living in Canada, they don't file a Canadian tax return, the trust would have to withhold tax on the income that it's going to be distributed to the U.S. beneficiary. Typically, it's a 25% tax rate, but the withholding tax could potentially be reduced under the income tax treaty between Canada and US to 15% or 0, depending on the type of income we are discussing about. So similar, whenever you are managing the executor, you're managing an estate located in Canada, whenever you have a beneficiary that is not in Canada, you have to pay special attention to it on how to allocating the income to the beneficiary, whether you have fulfilled all the withholding tax. Because if you don't meet all the follow all the procedures, the estate is going to be liable for any penalty or interest on it. And then eventually, if all the asset has been disputed out, then comes back to the executor. So that's why being an executor or the trustee of a trust is really important. You have to pay special attention to a lot of different issues. Otherwise, you would be personally liable for a different type of penalty or tax.
Yeah, and I think the flip side of that, just from the beneficiary's perspective, to remember, in Canada actually has a similar type of rule, that if a U.S. beneficiary receives monies or income from a non-U.S. trust, they have reporting down in the U.S. Canada also has a similar rule. If a Canadian receives a distribution from a non-Canadian trust, there's a reporting requirement that needs to happen. So it's just, I mean, at the end of the day, I always say to people, the income tax calculation of the tax is somewhat the easy part of a tax return. It's all the other reporting that is where it gets complicated.
Yeah, and then like anything else, anytime you transaction money cross the border, you have to think about a disclosure as well. And more likely than not, it's going to be disclosable on some of the forms in either countries. Exactly. So we actually cover all the topic that we have today. So shortly after the webinar today, the audience would receive a short survey from us. Just feel free to tell us how we can improve and the topic that you would like us to cover. So right now we're going to stay here for the question that we received from the Q&A sections.
And I'm actually just going to point one thing out here on our screen. You'll notice some QR codes, and those are live QR codes. One will take you to our website, and one takes you to the YouTube channel if you want to go check out previous recordings of all the other webinars that existed. So Kathy, Francis, do you guys have some questions for us?
Yes, we do have a couple questions for you. Some of these aren't very complicated, but I think a lot of audience members would like to know, so I'll just ask them anyway. Our first question is, if the estate is less than the exemption amount, does the estate tax return still have to be filed?
Phil, do you want to take this? Or?
Sure. So depending on the estate or the nationality of the deceased, if he died as a U.S. citizen, the answer is no. but there was also some benefit for you to file an estate return. There was some option to carry forward some of the unused lifetime exemption to the surviving spouse, depending on the citizenship, etc. And then if the deceased taxpayer is, let's say, a Canadian, but owning some US citus asset, and then the US citus asset is over $60,000, a US estate tax returns need to be filed to claim the income tax treaty benefit, claim the lifetime exemption, and report the US citus asset.
Yeah, and that the thing that Philip was alluding to there is a portability election that can be done in the US in order to take advantage. Say the threshold's 12 million right now, but the person's estate was worth 10 million. And maybe they died young, so the value of the estate might continue to increase, and they had a US citizen spouse. You might choose to file a US estate tax return regardless in order to take advantage of that and to get that doubled up amount of the US stated tax exemption, even though it's not required.
Perfect. Thank you very much. Our second question is, Canada allows pension sharing and spousal loans for investing. Does this trigger the attribution rules when it comes to estate planning?
So the attribution rules is a Canadian rule. It's an income tax rule, not an estate tax rule. So Canada does allow the pension splitting, so the attribution rule does not apply for that. However, for estate tax planning, even though you choose to split your income on the Canadian return to get an overall lower tax rate, 100% of the pension needs to still be included on the US person's US return. And if it's their pension, the value of that would be included in their estate upon passing. So it's kind of two separate rules. One is income tax rule for Canadian purposes, what the attribution is, and really has not much to do with estate tax calculations.
And I could comment a little bit about the spousal loan. So I think the audience is referring to the common planning of one of the spouse that presumably makes more money and making a loan to the lower income spouses for invest, and then charging a lower interest rate, hopefully that the lower income spouse could earn enough or high enough investment income that after taking the interest expense deduction is still worth, that still have some positive investment income to kind of achieve the overall goal of income splitting. The question whether it would trigger a gift is depending on how the loan was drafted. They have the concept of bona fide loan in the US. So the idea is really, you have to think about it is it the loan is fair enough? Are you going to lend the same type of money to a non-related third party? And then if there was any interest repayment, so you could not just say, hey, I'm going to charge maybe a really, really low interest rate, and then there was no repayment at all. Then they would start questioning, is it really a loan or just a gift? So that's really the kind of the concept of how they kind of try to identify whether that's actually a loan or just a gift. And in the case that they come back with documentation saying it sounds more like a loan, sounds more like a gift, then the gift tax would apply. Then you would have to review the annual gift exemption. If it's over, then you might have to file a gift return to use some of the lifetime exemption.
Perfect. Thank you both for clarifying that. The next question is in relation to gift tax and generation skipping tax. So the question is, what about gift or estate transfers to siblings or indirect descendants like nieces of the deceased? Do the exemption amounts apply to these cases as well?
So the overall exemption applies to any gift to any person. So the 12.06 million exemption applies for any gift to anywhere. There are some exclusions for that. So for instance, if you're giving money for medical purposes for your children or education, then they actually don't fall under these gifting rules. And we had talked about that in one of our webinars on the gifting. But yeah, no matter who you give the gift to, the exemption amount is available.
Yeah, and I would probably expect that the audience want to ask whether that would the generation skipping transfer tax would apply. You would still apply that standard on whether it's more than one generation down. So if the nephew and nieces, they were still within the one generation, then generation skipping transfer tax would not apply. But in the case that you say, I'm going to give money to my grandchildren during the lifetime, then the generation skipping transfer tax would also apply. It would apply the same way if the gift was made during lifetime or after death.
Perfect, thank you. Our next question is, in relation to the spousal trust strategy in favor of a U.S. spouse, would it require the income only, if we're not talking about the capital here, to avoid it from being included in the worldwide asset test?
So regarding the spousal trust, it's a specific type of express trust that is referred under the Canadian tax concept. How the trust instrument was drafted is, during the lifetime of the surviving spouse, he or she is the only one that could receive all the incomes. And then by the time he passed away, all the capital inside of the trust will go to the succession beneficiary. So that's how it kind of avoids being included in his or her estate when he passed away, because the asset would go to some other beneficiaries.
Okay, thank you very
I don't have
much.
anything to add on that.
Our next question is, if a Canadian and U.S. citizen living in Canada receives funds from a U.S. trust, is there a reporting requirement for all amounts?
They're a resident in Canada, then yes, they would be required to, if it's a U.S. trust that they're receiving money from as a Canadian resident, there is a form in Canada that needs to be filed to report that receipt.
Perfect. Our next question is, my husband is Canadian and I am a dual citizen of Canada and US. What is the risk if I predecease him? All our accounts are joint.
So say that again, sorry. The one spouse is a Canadian US citizen and one is just a Canadian?
Yeah, so the husband is just Canadian.
Yeah.
And the asker is a dual citizen. So what is the risk if the dual citizen predeceases the Canadian only person?
Yeah, I think it depends on where the assets are. I don't know that we can give that answer because it depends where your assets are located, the value of your estate, where's your husband located. I think there's a little too much information. We could potentially reach out to you and talk to you about that if you want.
Okay, sounds good. We have another question here. Does owning US stocks require Canadian citizens and residents to pay US tax upon death of the surviving spouse?
If a person passes away and owns greater than $60,000 of US stocks, even if it's in a Canadian brokerage account, yes, you are required to file a US estate tax return. And if you're over the threshold of the 12.06 worldwide assets, you will be subjected to US estate tax.
Perfect. I know we're past 10 a.m. Are you still open for another question?
We could probably take a couple more. Are you okay, Philip, if there's a couple more here?
Yeah.
Okay. What are the key factors to consider for estate planning when one spouse is a US and Canadian citizen, the other is Canadian, and the children are US and Canadian citizens?
Well, again, I don't know that we can answer that because it really depends on the value of the estate, where the assets are, where the people live. Again, we're open to talking about that. I think we've talked about a few things here, and I know we have a webinar coming up in a couple of weeks in which we're going to talk about a bit more planning options with Warren Duick and Atif Mir, who are with our firm as well. So they have another seminar or webinar coming up in a couple of weeks on a similar topic to delve a little bit deeper as well.
Perfect. Thank you very much. We have one last question here. And the question is, does it make sense to have a will in both Canada and the US if there are assets in both countries?
So it probably makes sense. I think one of the key things is you have to make sure that both will are still correctly drafted for the purpose that you want to achieve. Maybe you want to have the US will to be addressed only regarding the US asset. That's probably okay. You just want to make sure that you don't, your Canadian will still applicable, because most commonly whenever people drafting will, they would see all the preceding will would be no longer valid, right? So you want to make sure that you achieve whatever you want to achieve. So you have to pay a lot of more attention on the language you use and what would be covered by those will in either country.
Yeah, exactly. And making sure you have the executor in the right country. Awesome. Well, thanks, Kathy, and thanks, Francis, as well for moderating the questions. We had a good time, and as always, please make sure if you have the time to fill out the survey and give us feedback. And for those questions we were unable to answer, I know we received a lot of questions in advance as well, and some a little detailed. We'll be reaching out to individuals to help you with your questions.
Thank you for attending.